Okay, we've talked about cyclicality in a few different contexts in the history of this channel. And before I even get started with this video, I want to point you to videos 53 and 54, where I talk about one aspect of cyclicality in the investment world, in the stock market. And then video 82, where I cover literally a cyclical company and what can happen with their results during a period of boom or bust. Okay, so this is a concept, this sort of greater concept of cyclicality is something that shows up in a lot of different subdomains in investing. And I think it's really important if you want to raise your game as an investor to kind of be open to more and more nuance of the ideas of cyclicality and how it can show up in different ways in investing. So today, what I want to do is talk about cyclicality in the context of investment returns. And I want to introduce the idea with sort of a thought experiment. If you imagine some fund that reaches you, maybe through an advertisement or being talked about on financial media, or you read an article about it in Barron's, something like this. Imagine the fund's performance over time and when it is most likely to reach you. So think about mutual fund companies. They almost always will advertise some fund and advertise it aggressively after a period of very good performance. And if you think about like a hedge funds are not allowed to advertise like mutual funds. It's a different regulatory system for them, but they can go market to individual accredited investors. Of course, they're going to do it after a period of really good performance. And so this goes to the cyclicality of how investments are presented to investors or how products are sold to investors. Usually it's after a period of outperformance. And again, going back to the idea of cyclicality, in investing, there are periods of outperformance followed by periods of underperformance. And there's sort of a natural mean reversion of investment performance, just like there's a mean reversion in a cyclicality with booms and bust cycles for any given industry. And so what I want you to learn from this video is to be very wary of any product that is sold to you, which is another sort of consistent mantra that I talk about. Never buy an investment that's sold to you. However, just to recognize that investments and firms tend to go out and gather assets after their performance has been very, very good because they have good performance to advertise, right? And on one level, this is sort of circular and sort of duh, but many retail investors kind of get suckered by this idea. You know, and also we all know the phrase past performance is no guarantee of future results, right? Like that's a mantra too, but yet it's still, the system is designed to present investments to you after they've had a period of outperformance. And yes, it's possible that outperformance may continue. It's not that likely, to be honest. Most things go in cycles, and after you see a period of outperformance, quite often it's followed by a period of underperformance. And so you want to avoid these types of products. And naturally, the firms selling these products to you, they desperately want to go out and gather assets after they've had a period of good performance. And of course, they don't know, it's not like they're deliberately underperforming going forward. It's just this is sort of natural mean reversion that happens with investments. However, this is it's a sucker trap really for a lot of retail investors. And you don't want to be like a retail investor who just is like, oh, this fund has great performance, let me put money into it. You want to think about the generator of that great performance and the decisions made by somebody running such a product or such a fund, and that, of course, they're going to be aggressively marketing it after this period. So you want to be avoiding products like that, and really you kind of want to be more looking for products that have had periods of underperformance, and which is sort of a little bit more difficult because those products are kind of going to be invisible. They're not going to be as aggressively marketed. They're not going to be talked about in financial media. So it's really more on you to rely on your own resources to try to find types of products that have had periods of underperformance that may later mean revert into outperformance, right? So this is a bit of a nuance, but I want to just convey, again, another aspect of cyclicality that shows up, one of a million different aspects of cyclicality in the investment world, and it shows up in investment performance. And good performance is often followed by poor performance, which is often followed by good performance, right? And so keep this in mind when you see a sector that has shown significant outperformance in the recent past, any mutual fund or any kind of financial product sold to you that has had very good recent performance, stay away, right? And then look for the opposite. Okay, so just essential insight, and again, cyclicality, one of these really important concepts, and don't let it show up in investment returns and harm you as an investor, where you get sucked into some product that appears to have good results, but then is about to enter a period of subpar results. Okay, as always, thanks for watching.